Welcome to TalkTickers. Our mission here is really to cut through all the jargon and unpack the key nuggets from earnings conference calls.
Make sense of it all quickly.
Exactly. Today we're diving into the Sportsman's Warehouse Q1 2025 results. We've gone through the prepared remarks, the Q&A with analysts
It's the whole thing.
to figure out what really matters. So let's just jump right in.
Sounds good. And this one's pretty interesting because, well, it's their first positive year-over-year sales growth in almost 4 years.
4 years. Wow. That's a long time.
It is. So it's a good chance to see if that turnaround plan they've been talking about is actually starting to, get some traction.
Okay, so 4 years is a long time. What were the headline numbers for Q1 that signaled this shift?
Right. So looking at the top line, net sales came in at $249.1 million. That's a 2% increase compared to $244.2 million last year.
Okay, 2%.
And that 2% positive sales comp, that's really the main headline, breaking that long streak of declines.
Got it. Sales up, definitely a big positive.
Yeah.
Did that flow through to better profits straight away?
We saw some improvement, incremental improvements, I'd say. Q1 is usually a loss-making quarter for them, seasonality.
Right.
But gross margin did tick up a bit, 20 basis points, so 30.4% compared to 30.2% last year.
Okay.
And they got some leverage on SG&A expenses too, selling, general, admin costs. Those improved as a percentage of sales, 38.2% versus 38.6%.
So costs grew slower than sales then?
Exactly.
Okay, so improving sales, slightly better margins, costs under control. But the reported net loss, that still got a bit wider.
It did, on a GAAP basis. The net loss was $21.3 million or 56 cents a share. Last year it was $18.1 million or 48 cents a share. But if you look at the adjusted figures, which, strip out certain items to give maybe a clear picture of the core business.
Right, the underlying performance.
Yeah. That actually improved year over year.
Yeah.
The adjusted net loss narrowed. It was $15.6 million or 41 cents per share compared to $17.8 million or 47 cents per share last year.
Okay. That makes more sense alongside the sales growth. And adjusted EBITDA, that other key measure.
Adjusted EBITDA was $9 million for the quarter. That's up slightly from $8.7 million last year.
Gotcha.
So, the adjusted numbers, they show that modest improvement, which kind of lines up with the positive sales trend and the cost management efforts.
That first positive sales comp in 4 years.
Yeah.
That's still the big story here for a turnaround. What did management actually say was driving that? What's the strategy?
Yeah, they were pretty clear this wasn't just luck. It's part of their ongoing business transformation plan. The focus is simple: get back to same-store sales growth and improve operating margins.
Okay.
And they laid out 4 key areas, like pillars of disciplined execution they think are making the difference.
All right. What are those 4 pillars?
First is inventory precision. Sounds a bit corporate, but basically it means being smarter about what they stock.
How so?
Being narrow and deep. So focus on having plenty of the key stuff, especially in hunting and fishing, the things that drive most sales, maybe fewer, niche items.
Okay. Precision, what's second?
Second, local relevance. Giving their store outfitters, the folks on the ground, more power to use their local knowledge and connections. Tailor the store experience.
Makes sense.
Third, personal protection, building up their authority and capability in that category. It's a big market.
Right. And number 4?
Fourth is brand awareness. Just reinvigorating the Sportsman's Warehouse brand, trying to connect better with customers, bring them in.
Okay, so inventory, local, personal protection, and brand. These are the initiatives they think drove that 2% sales lift, even with, consumer pressures in the late spring they mentioned.
Exactly. That's their story. And here's a really fascinating piece of data they shared.
Oh, yeah.
Their firearms unit sales significantly outpaced the adjusted NIC's data.
NICs, the background check system, the proxy for gun sales.
Right. So adjusted NIC's data was down 5.4% in Q1, but Sportsman's Warehouse said their firearm unit sales were up nearly 7%.
Whoa. Okay, up 7% when the market proxy is down over 5%.
Yeah.
That's a big difference. That sounds like market share gains.
It certainly points that way, doesn't it? But there's a caveat. They did note customers are trading down.
Meaning buying cheaper guns.
Yeah, essentially. Buying lower priced options within the category. So the average unit retail, the AUR for firearms, was actually down 8% year over year.
Ah, okay. So more units, but lower price per unit?
Precisely. So they've adjusted their product mix to capture that demand for, value priced firearms. And they're working on the accessory side too, trying to increase the basket size, get higher attachment rates when someone buys a gun.
Makes sense. What about other categories? How do they do beyond firearms?
Pretty good performance in most core areas. Besides guns, clothing, and footwear helped, ammo was up a solid 3%, and fishing was really strong, up 11%.
11% in fishing. That's quite good.
Yeah, and they specifically mentioned the 2-year fishing comp is 12.3%. They see that as validation for their new merchandising strategy. Fishing was kind of the test case. Seems like it worked.
Any weak spots?
Camping sales were down. They mostly blame that on the later spring weather and the timing of Easter this year, hitting early season outdoor stuff.
Right. So it wasn't just what people bought, but how they shopped. Any improvements there?
Absolutely. They reported positive trends in customer traffic, both in stores and online. More transactions overall, higher basket size UPT, units per transaction, and higher average order value, AOV.
Okay.
They think their strategy, better in-stocks, getting those attachments, that's what's driving these better metrics.
And the website, their digital business.
E-commerce is also pulling its weight. It posted an 8% positive comp, actually outpacing the overall business growth.
Faster than the stores.
Yep. They put that down to a new digital-first marketing approach and just improving the omni-channel experience, making it easier for people who shop both ways.
So if you had to pinpoint the biggest operational changes that really drove Q1, what were they?
They hit on a few key things. First, just much better in-stock levels on those really important core items, making sure the top sellers are there.
Okay, availability.
Second, being ready for the seasons on time. Stores, online, ready to go. They mentioned fishing again as a big win there.
Right.
And, this seems important, a strategic shift to everyday low pricing on core ammo calibers and consumables.
The EDLP approach on ammo.
Yeah. And that strategy apparently drove a big 12% jump in ammo unit sales. And crucially, it brought more traffic into the stores.
Interesting. Traffic driver. I think you mentioned localization too.
Yeah, they said they've made significant progress there. Localizing assortments, using geo-targeted marketing. They used Alaska as an example. Aligning products and marketing better with local seasons there led to better results.
Okay. And tell me more about this personal protection push. It sounds like a deliberate focus.
It really does. And they seem pretty bullish on the future potential there. They launched a safety outpost section on their website, home defense, situational awareness, that kind of thing.
Right.
They ran a campaign with Springfield Armory. And this is interesting. They soft launched a less lethal strategy with a partner called Verna.
Less lethal. How do they roll that out?
Not just putting product on shelves. They did it in 11 stores with full shops, another 40 with smaller setups. And these places actually have live fire demonstration capabilities.
Live fire demos. In store.
Seems like it. And they said test pilots showed really significant conversion rates. So it seems to be resonating. They see a lot of upside there.
It sounds like they're really trying to change how they interact with customers across the board.
I think that's right. They're also launching a new omni-channel brand campaign. And the idea is to, reignite the brand relevance, hammer home their competitive advantage. That combination of local expertise from their outfitters, plus a good mix of value, quality, and selection. They feel that lets them compete with the big boxes and the smaller specialty guys.
So despite those consumer headwinds they mentioned, management sounds pretty confident about their plan.
Definitely. They express confidence in the plan and, maybe more importantly, in their execution. They're focused on controlling what they can control, right? Variable costs, inventory levels, merchandise margins.
Right.
And they believe this operational discipline will keep driving sales growth, improve margins over time, and let them pay down debt.
Speaking of inventory and debt, let's shift to the balance sheet. Inventory levels were up in Q1, weren't they?
That's correct. Total inventory at the end of Q1 was $412.3 million. That's up from $391.6 million last year.
Why build inventory now, with consumer demand maybe being a bit shaky?
Yeah, good question. Management explained it was a specific strategic decision. They pulled forward about $20 million of inventory.
Pulled forward. Why?
Two main reasons, they said. First, get ahead of potential rising tariffs on imported goods. Second, just make sure they were fully stocked and ready for the really important spring and summer peak selling seasons.
Was it just buying more of everything, or?
No, they were clear it was targeted, focused specifically on core, high-turning, seasonally relevant stuff. Ammo, fishing, camping, personal protection.
The stuff that sells anyway.
Exactly. They called it a low-risk investment because these are items that typically sell through fast, especially in peak season.
How did pulling inventory forward affect their accounts payable? bills they owe suppliers.
Right. Their AP balance was higher than usual in Q1 because of that pull forward, but they expect it to normalize, come back down in Q2 as they sell through that inventory.
And they also mentioned cutting down the number of products they carry, SKU reduction.
Yes, big progress there apparently. Cut total active SKUs by about 20% compared to last year.
20% fewer items.
Yeah, the goal is to simplify things, improve inventory turns, drive better margins over time by focusing on the stuff that really sells.
Okay, wait. So they strategically bought more inventory in Q1, but they're also cutting the total number of products and aiming to end the year with less total inventory? How does that square?
It does sound a bit contradictory at first, but it's about having the right inventory, not just less inventory.
Oh.
They pulled forward specific high-demand items for the peak season and tariffs, but they're also cutting out the slower-moving, less productive SKUs across the board. They seem confident they can end the year with lower total inventory than 2024 while still having the right stuff. Better buying discipline is the key, they said.
Got it. What about their overall financial health? Cash? Debt?
They reported liquidity of $122.1 million at quarter end. Debt balance was $166 million. They described their liquidity as strong and said they're actively managing working capital.
Is paying down that debt a priority?
Absolutely. They said a top priority for the year is generating positive free cash flow, cash after operations and investments, and using that extra cash specifically to reduce debt, strengthen the balance sheet.
Okay, let's look ahead then. The full year outlook, what did they guide for fiscal 2025?
Despite acknowledging the macro headwinds and potential tariff pressures later on, they actually reiterated their full year guidance. Same guidance they gave before.
They stuck with it. Okay, and what is that guidance?
They expect net sales for the year to be somewhere between down 1% and up 3.5% compared to 2024.
Okay, so potentially still positive for the full year.
Potentially, yeah. Adjusted EBITDA is guided between $33 million and $45 million. They expect modest gross margin improvement and continued cost discipline.
And spending, CapEx.
Capital expenditures between $20 million and $25 million, mostly for tech investments, improving store service, merchandising tools, plus just normal store upkeep.
How confident did they sound about hitting that guidance?
They seemed pretty confident. They expressed confidence in hitting that range, provided, consumer spending doesn't suddenly fall off a cliff. Barring any drastic reduction, they feel good about it.
And how does that $20 million inventory pull forward play into the potential tariff impact? Does it delay the hit?
That's the idea. They expect it to help buffer the P&L from significant tariff impact until maybe partway into Q3 or even Q4. They're constantly looking at pricing item by item to offset costs, but they have to balance that with the everyday low price strategy on things like ammo that drive traffic. It's tricky.
Right. And did they confirm that strong firearms unit performance beating NICs continued after Q1 ended?
They did, yeah. They specifically confirmed that trend of significantly outperforming adjusted NICs continued into May, exceeding the industry trend by, quote, more than double digits on a unit basis.
Wow, even into May.
Yeah. So even with the AUR pressure from trade downs, they feel their strategy is working to capture demand. And they also noted that overall positive comp trends across the business continued into May as well. So some momentum heading into Q2.
Okay, so we've covered the results, the strategy, the balance sheet, the outlook. What does this all mean? Let's put on our speculative hats for just a second here.
Right. And the big disclaimer, this is purely for entertainment, absolutely not financial advice. Do your own homework, your own rigorous due diligence before even thinking about making any investment decisions. Seriously.
Couldn't agree more. Okay, disclaimer delivered. Based purely on what we heard in this call, what are some, let's say, outrageous but plausible trade ideas someone might cook up?
Okay, outrageous but plausible. Idea 1. Think of it as a seasonal, inventory-driven long play.
Okay.
They were super specific about pulling forward that $20 million in high-turning core seasonal inventory, hunt, fish, camp, ammo, to be ready for peak season and tariff. They called it a low-risk investment. So the argument could be, maybe the market is missing how effective this could be. Having the right stuff in depth for the first time in years during peak season, especially after seeing fishing comps improve and hearing the positive trend continued into May.
So the pitch is?
Go long, SPWH, but specifically timed for Q2 and maybe early Q3. Bet that this granular inventory management actually works this time, leads to stronger than guided results in the peak seasons, then maybe unwind it later as they work down inventory into year end.
And the outrageous part.
Betting that this very specific operational detail kind of buried in the call can actually overcome broader market worries and move the stock significantly. It's a micro bet against a macro backdrop.
Interesting. Very specific timing. What's idea number 2?
This one's the market share aggressor play. Focus on that firearms data. Significantly beating adjusted NIC's units, like more than double-digit outperformance continuing into May. Even with lower AURs, they're meeting demand for value and trying to attach accessories.
Right, the market share gains you mentioned.
Exactly. So the speculative angle is, what if this isn't just a one-off? What if it's a structural shift? Maybe they're really taking share from competitors who can't match their value mix or local service.
That's the right idea.
Go long SPWH based on this potential sustained market share capture. And maybe, just maybe, pair it with a short position in a competitor you think is losing that share. Could be another retailer, maybe even a gun maker who relies more on high-price sales.
And the outrageous part of that one.
Assuming, based only on this call, that SPWH's outperformance is entirely due to their strategy and is sustainable, not just an inventory blip or something temporary. And, crucially, assuming you can accurately pinpoint which competitors are losing out just from this information, that's a big leap.
It definitely requires some bold assumptions.
Yeah.
Okay, let's step back from the speculation and recap.
Right. So wrapping up our deep dive into the Sportsman's Warehouse Q1 call, they hit that first positive sales comp in almost 4 years. Management says its early signs their turnaround plan is focusing on inventory precision, local relevance, personal protection, and brand awareness.
Key drivers seem to be better in stocks on core items, that everyday low price strategy on ammo driving units and traffic, really strong growth in fishing, solid e-commerce performance, and making progress on localizing assortments. And, importantly, that big outperformance versus the firearms market in unit terms, suggesting market share gains, which they said continued into May.
Yep. They're actively managing inventory. That includes the strategic $20 million pull forward for peak season and tariffs, but also cutting total SKUs significantly. The goal is lower overall inventory by year-end while generating free cash flow to pay down debt. That's a major priority.
And they stuck with their full-year guidance, expressing confidence despite the macro environment. They noted the inventory move helps buffer tariff impacts for now, and that positive overall comp trends from Q1 carried into May, giving them some momentum.
What really stood out, I think, was the level of operational detail they shared on the call. Specifics on the inventory pull forward, the Verna partnership trials and personal protection, confirming those market share gains and positive trends into May. Pretty granular stuff.
Yeah, it really was. Which kind of brings us to the final thought, the question for you, the listener, to chew on. How much can this kind of granular operational execution, the precise inventory moves, the localized assortments, building out specific categories like personal protection, how much can that truly offset the broader pressures on consumer spending right now?
Exactly. Can a company like Sportsman's Warehouse execute its way through a tough environment strongly enough to make a real difference? That's really the core tension to watch as this turnaround story continues to unfold.